I have to explain to the media over and over again is this scenario played out in Riverside, in San Bernardino, in Stockton, in Florida, in Arizona. It was people who shouldn't have been qualified to buy a loan, to get a loan, buying an overvalued house that they really couldn't afford with a risky, toxic loan product. And that turned into a soup that made them all very, very sick. Wall Street securitized these loans, which looked like a good idea at the time, except they had this voracious appetite for very exotic loan products. And I actually heard this anecdote at another conference where somebody said, I was talking to the guy at Bear Stearns, first mistake. I was talking to the guy at Bear Stearns and he said, how come you can't get us a higher volume of these loans? He said, well, it takes us about 30 days to do due diligence. We have to find out they are who they say they are, that they actually have a job, they actually have assets, they can actually afford the loan. And he said, well, what's the fallout rate? How many people fail the test? And he said, about 3%. He said, well, forget about the due diligence. If it's only 3%, we can write that off. It sounds like a ridiculous story, but it's so ridiculous I actually believe it. I believe that's actually the kind of thing that went on in the industry. And you're watching these people who are always the smartest kids in the room suddenly running for cover on Wall Street. But they shifted the risk from the banks to some poor guy who was managing the retirement funds for the grape growers union in Tuscany, who suddenly owns 20% of your mortgage. And if you need to do that loan modification, he has to approve it. He owns the risk. He makes that loan that much more difficult to adjust and modify. And we had two fundamental changes in behavior that never should have happened at the same time, but they did. One fundamental change was the banker's mindset shifted from, we're going to make you a loan and we're going to hold that loan, to we're going to make you a loan and we're going to sell it to Wall Street. So it went from buy to hold to buy to distribute. I'm moving the risk from my place to your place. And while that was happening, the consumer mindset changed. The house was no longer a place to park your car, it was a place to park your money for a little while, till you could flip it, because there was a TV show called Flip This House, and if those idiots could do it, I could certainly do it. So what has all this abhorrent and ridiculous behavior led to? Probably the largest confluence of foreclosure activity in the history of the country, by anybody's numbers. And what we're looking at is the light blue bar is the total number of foreclosure filings. We capture foreclosure data from 2,200 counties across the country. All three types of filings, the initial notices, the notice of sale, and the REOs, the repossessions. If you look at the range of growth in those filings, we went from about 1.2 million in 2006 to over 2.3 million in 2007. It was a 75% increase. If you look at the number of individual U.S. households that received a foreclosure notice during that period of time, we went from a little over 700,000 to almost 1.3 million. 1.3 million U.S. households received at least one foreclosure notice last year, a 79% increase. In California, the numbers were even goofier. We had filings grow by 338% in 1 year, and the number of households grew by 285%. Ridiculous numbers. And the really good news is, if you like charts that go up, this year's numbers are going to keep going. This is an eye chart. I'd like you all to identify your county by pointing. If there were ever a debate as to what kind of state California was, this has clearly become a red state. So the areas with the red and the pink are areas that have a higher than average incidence of foreclosure activity. The areas with blue have a lower than average incident. We figured out, by the way, that there are purple states. If we took the top 10 states in terms of foreclosure activity and called them purple, whoever's running for president could win the election with about another 70 electoral votes. The top 10 states in terms of foreclosure activity. So what you're seeing is a confluence of foreclosure activity in areas like California, like Arizona, like Nevada, all for the same reasons we've talked about: overvalued houses, risky financing. If you look at places like Michigan and Ohio, God bless them, they're having foreclosures for old-fashioned American reasons. The economies stink. But if you look at the areas with the highest numbers of foreclosures, California has it hands down. 7 of the top 12 markets in the country in terms of foreclosure activity are in California. In Stockton, in the second quarter, 1 in every 25 households received a foreclosure notice. 1 in 25. Look around this room. If there are, I don't know, 400 of us here, how many people would have gotten a foreclosure notice based on those numbers? So very, very high incidence. In 07, we saw the first time in years that the number of foreclosure properties sold actually increased higher than the number of new homes sold. That number is going to go up this year to at least 25%. Not the 80% you read about in the press, but the numbers are definitely going in the wrong direction from an overall economy standpoint. So I got to notice I have to keep moving really quickly. So some of these charts are hard to read, but very self-evident. The bars on the bottom are the number of foreclosure properties that we're dealing with. The line on the top in this case is inventory. And as you can see, the number of foreclosure properties going up, the number of bank-owned homes goes up, the inventory numbers build. So the inventory you're seeing is going to be inflated dramatically by the number of bank repossessions. What's that doing in terms of new home starts? Well, no big surprise here. This is one of those glaring moments of duh. As the inventory numbers go up, new home starts go down. Foreclosure activity is driving that, so we're seeing a direct correlation. If you take a look at existing home sales, what we're hoping we would see is as home prices go down, the inventory builds up, you're going to see more of those homes sold that are on the market. We're not seeing that yet. Those numbers continue to go down, and a large number of those properties are the bank homes. A lot of opportunities for investors, but tough sledding for the rest of us. I know Chris looked at the Case-Shiller numbers too. If you take a look at August of 07, which before this quarter was our prime period for foreclosure activity, that's when the market started to go down. So there were, if you, two more slides and we'll be done. They gave me a I'm done here kind of message. In California, you can see that when we hit that peak in August is when the values started to plummet. And this is the state hardest hit, at least in our analysis, and the correlation between foreclosure activity and prices is clear. We see at least 3 million foreclosure filings this year on over 2 million U.S. households. That number is not going to get better. We're probably going to revise that projection. There are $100 billion of subprime adjustable loans that are resetting between June and the end of this year. Those are the ones that started this whole mess. So we're going to see historically high levels of foreclosure activity at the end of this year. 32 consecutive months of growth year over year in terms of foreclosure activity. That's not changing. May is the highest month we've ever recorded. July is the second highest. The REO inventory is going to be over 1 million homes by the end of this year. And Alt-A and option arms are going to be the next wave, and they're going to start in 09 and have a huge period of resets in 2010. So I hope you've enjoyed that glimpse of the future. And it does present a lot of opportunities for people who are investing, and I wish you all the best of luck.